Good evening. Ira Epstein of Linn Associates with your financial market wrap-up for this Thursday, the 21st of May, 2020, the time about 6:20 p.m. Central Time. So we're getting a bounce back in a stock market that broke today. Remember, we're into the Memorial Day type of psychology in the market. A lot of people square up for the holidays. Europe, Asia's open. We're closed, so markets can get a bit out of balance. Metals broke hard today. They're trying to rally back a bit, as you can see. Dollar stronger against a number of the foreign currencies at this point in time. And the energy market went sort of quiet, but still a powerful rally. You've given up the best part in the crude. You were up over the $34 mark plus, but we'll see what that wants to do. So as I take a look at where we're at in the S&P on a weekly chart, this is a resistance point, the 2925 area. You're still over it. You're up 97 points for the week. It's possible it'll hold on to that and close higher for the week, but you're right in that zone where I expect to see some resistance. When I come over and I take a look at the June S&P daily bar chart, you're at the 62% area. We did this here, and we came back and are challenging it here. Now, if you get much over these highs, I'm going to throw out this Fibonacci count because it won't be valid in my opinion. Getting back to these lows, very, very difficult. On the way down, I had one of you viewers write me, and he was right. As the market was coming down, in March, I said, you're looking at generational lows. And it turned out to be the way. When I was on Fox TV as this was happening, I kept telling people, you want to buy stocks that you like in dribbles. Just keep buying. You're never going to catch a bottom. I don't know how. Most of the pros don't know how. That's not what it's about. Investing is different than trading. But when you come down like that in a market that is just a fake cause of a COVID-19. Now, what I mean by fake, we know COVID's real, but it's not an economic cause that caused this. It was a medical situation, a disease, a virus. That's what caused it. Underlying all this, everybody wants to go to work. Here's the dilemma. They're not going to be able to. Here's the dilemma. This isn't the light switch you throw back on and everything's fine right away. Here's the dilemma. A lot of bankruptcies are coming. Here's the dilemma. Small businesses that the government says they're helping, they're not coming back. I look around our neighborhood here where we have boutique shops everywhere. I'm in the hottest area of the city. This is what's called in Chicago Fulton Market. This is where Google, Facebook, everything's here. All the restaurants are here now. And folks, these stores cannot pay the rents they're charging down there unless something happens. I don't know what that something is. When we take a look at how the chart action is, we've got the higher lows, certainly the higher highs. You'd have to take 2908.50 out to create a pattern of a stall in the market where you've got a higher high and a lower low. Haven't done that. The support in the market back at the 18-day average, which is underneath that 2909, and serious resistance is right here from the 100-day average to the 200, and then let's throw in my old friend, the Bollinger Bands, right through there. The Three Musketeers, that's pretty stiff resistance. Does not mean you can't get through it. It's stiff resistance. You know, you can throw all the resistance you want at a market, they break through it. Armies can throw all the defenses they want. They get beaten. You know how that works. So we'll see if the market does it or doesn't. In terms of the momentum, you are overbought. So as a technician, no, this is not a buy zone. End of discussion. This is where the pros should be coming out, not going into the market. In the NASDAQ, you had a reversal off the upper Bollinger Band, but this is what you've been doing. You keep hitting the band, dropping away, like you're doing right now. If you take out 92.73, I would have no reason to think you might not find support at 91.18. What about the slow stochastics? Have they embedded? Well, both numbers, and I don't want to count tonight because we don't know where Friday's going to finish. So Thursday, both are over 80, both over 80 on Wednesday, not over 80 on Tuesday. Aha. So the Friday action is going to be the key. You will embed if you're just like this, up 36 points. You won't if you break through these numbers and you start dropping. The question is how far to drop before you're not embedded. I have no intent of seeing if it embeds or not. When I look at the Dow, overbought into key resistance of the upper band, this is a pipe. Think of it that way. You're laying on this pipe and you're just spinning your wheels in here. I've done this for years, and I try to catch the breakouts. You give up after a while. You learn that it's easier to come in after the fact, because what happens is it eats you up, and by the time you should be buying, you won't buy because the market moves away. In the Russell, we have a market with higher lows, higher highs that's overbought. I don't see anything you want to do there. In the VIX, we have a market that's still lower highs, higher lows. So it's not a true downtrend. I look for the pros to write puts at 26.58 if hit, trying to get back to the 30-40 area. So you apply that strategy if you're interested. T-bonds caught in the pipe. Do you see that? If you've been trading that looking for moves, you're frustrated beyond imagination. Same in the 10-year, same in the 5 if you're interested. Then we get to the dollar index, which if it falls much further, if you look at today's low in the market, you got as low as 99.05. You didn't quite get to the lower band of 98.94, and now you're trying to rally a little bit. Okay, but you're basically caught in this sideways action and not much more than that. In the eurocurrency, the market has a pattern of lower low, higher high, and I think right here is where the pros stepped out of the market. Haven't changed my opinion. It's exceptionally strong resistance between the upper Bollinger Band at 101.19 and the 110.19 and 110.23, the 100-day average. That's a lot of resistance in the market. Japanese yen gave you one opportunity to come out of your shorts. You had it lower highs, lower lows, hit the number, and now you're stuck in limbo. You haven't moved one way. As for Bitcoin, well, the market answered my question. You know, we had stayed overbought. Now you've corrected that situation. You're going to fight a battle, I think, near the 18-day average of closes, looking for more direction. The market did give you the rally off the halving, but that's a long-term deal. You're just starting to see what this market could do if traders decide there aren't enough Bitcoins around. In the Brent versus the WTI crude, we keep narrowing in the spread. Now we're at $2.16, not $5, but $2 differential. The market's embedded, which means until that red line closes under 20, I remain in the bull camp, looking on breaks for the pros to buy and against the upper Bollinger to get out. Lose that reading, I think you'll go right back to the 18-day average of closes. The same in the WTI crude, embedded, higher highs, higher lows, running the upper Bollinger Band, and I think they'll buy probably the 3-day average of lows if you're interested until you lose that reading. Rebob gasoline, same thing. The market's bullish until you lose the embedded reading. Resistance will be the upper Bollinger Bands. And in nat gas, I was surprised the market fell. I thought today's number, frankly, the build of 81 billion cubic feet was about 4 billion cubic feet than the market's been looking for. It's less than the 5-year average of build as well. So we'll see. Is this market going to be able to carve out a low in this area? And there's formidable resistance right here, 203, let's call it, up to the 206.50 zone. You know, I talk about all these indicators, and we make it easy to learn them. With our good friends from Modern Trader, these are the guide to technical indicators. And it teaches you with examples of everything. We made these into PDFs, by the way, how to work with the moving averages, the oscillators I'm talking about. They give you a great overview with examples that are so easy to understand. I've been on Wikipedia, Investopedia. I think this is better than all of them. So if you're looking for something simple, free, you can print it out, you get a good overview, I think this is it. How do you get it? go to our website at www.iraepstein.com. Under the free offers, take a look at that, sign up for it, we'll get it to you. You can click up here, that'll take you to the free offer part as well. Try our other offerings. I think you'll find them interesting. I'm Ira. You have a great day, and I will talk to you all next week. No, actually, it'll be, let me think about that, Friday.